Welcome to the NEOS Monthly Income Podcast, where we talk about the importance of obtaining strong monthly income stream on your investments while also making that stream as tax efficient as possible. I'm Tom Lydon, and I'm joined by Garrett Paolella and Troy Cates, the founders of NEOS. Gentlemen, nice to see you.
Good to see you, Tom.
Good to see you, Tom.
Kind of another ho-hum month, not much going on, right?
Pretty boring, just hanging around, watching a slow, meandering market.
If you fell asleep at the end of March and just woke up, you might think nothing really happened in the market this month, but there was this period where we had a little bit of volatility, Tom.
Well, guys, you're right. I mean, there's been a lot of volatility in the market. We're going to talk about how you at NEOS incorporate volatility and make it work for you in your investment strategies. That's really going to be the main subject of today's podcast. But first, you've got some great news to share. Garrett, at the ETFcom Awards, you guys walked away with a little trophy. Tell us about it.
Yeah, thanks, Tom. It was an exciting night. We won the best new active ETF for QQQI, which was really exciting. It's the NEOS NASDAQ 100 high income ETF. And so we had the opportunity to really showcase the product and certainly win an accolade for all of our investors. So it was a very exciting time.
Yeah, and Troy, listen, it's well deserved. Talking a little bit, especially when you look back on last year from a performance standpoint, and then for the tax efficiency. Touch on that if you would.
Sure. So we brought the product out in January of last year. So we just have a little bit over a 1-year track record. The product has performed really nicely over that time frame. And yes, the tax efficiency with the monthly income is really important. I think that's what attracted so many investors to start looking at QQQI. We've raised over $1.3 billion in assets in the product. And I think looking at that tax efficient monthly income, annualizing at over 14% a year is what a lot of people are focusing on. And then if you pair that with the return of capital piece, which I know we've talked about before, where last year in 2024, over 95% of the distributed income was classified as return to capital. That's just lowering your cost basis and deferring your taxes to another date, which really is attractive to a lot of people.
Yeah, and we talk about tax efficiency all the time, but in this last month, I think a lot of people wrote checks to the state and to Uncle Sam, and it really comes home. As you're looking at getting that monthly income, it's nice to see it coming into your account. But at the same time, certain tax efficiency is there in some products and it's not in others. And it really came to the surface this last year. As you're talking to investors, Troy, is that something that came up more as we're going through this tax season?
Yes, I think as a lot of people were getting their 1099s and looking at what they owed to the government, what they owed to their individual state, they were trying to figure out how tax efficient all their investments are. When they come across QQQI and they're seeing that a good portion of that income they received last year is deemed as return to capital, it really helps out on that tax line and thinking about how you're investing and how you can keep that money and compound that money over time versus paying it in ordinary income in the year you received it. You're just deferring it down the road, but you could continue to compound it during that time. It's really important.
All right, let's dive into volatility. Most managers out there try to shy away from volatility, but you folks at NEOS embrace it. Let's dive into some of the conversations that you're having with investors. Garrett, talk a little bit about how you make volatility work for you, especially as it pertains to income.
Yeah, sure. So I would say we should bucket them across the different asset classes where we have product sets. So equities, fixed income, kind of alternatives in that hedged equity category. So if we start with just the equity category, I think one major notable difference between the way NEOS looks at managing through high volatility and low volatility times is trying to have more of a consistency to the distribution rate. There's a lot of other products out there that when volatility gets high, they immediately go out, sell options to try to generate a lot of income and distribute that out to shareholders. And so their yield or their distribution rate could double or triple over the course of a high volatility time versus a low volatility. For us at NEOS, we really look at how does that marry up with what the underlying index is going to do. So let's take again, because we're talking about a QQQI, right? When you have a time where volatility is high, you can generate more income for the portfolio. But what we like to marry is what is that upside appreciation opportunity on a go forward basis? Because if you just sell options to generate income, right, there is always a push and a pull to that. You're giving up some of your upside away. And so we like to focus on the upside participation, right, of that underlying exposure in addition to income generation. So you'll see that our distribution rates tend to be more consistent throughout low and high volatility times because we like to manage where our options are positioned to generate the income, but also to still allow for the appreciation that if the market snaps back after a sell-off, you're earning back as much of that underlying equity exposure as you can. So I think that's a major notable difference between the way we and our models run our products versus just others that are strictly focused on income generation without the total return element being a factor.
Garrett, go a little deeper and help me out with my little pea brain here. But during times of volatility, you can get actually a greater premium in those options. Explain how that works and then how fewer options can get you the distribution that you're looking for so more goes back to participation in the market, especially if we start to see things go back to the upside.
Yeah, sure. So if we're looking at either SPYI or QQQI, so our S&P or NASDAQ product, and you're looking at the volatility indexes, right, if they average kind of 15 to 18 and you're generating income of call it that 1% a month, right? You're probably going to overlay, on a portfolio of somewhere between 70 and 80%. As markets tend to have lower volatility times, meaning the equity markets are trending higher, volatility is coming down, you might be writing on 90% of the portfolio, and those options could be closer to where the current market price is of that index. Well, take this last month, you've had a big volatility shock, and those volatility indexes aren't at 15, 18, they're at 30, maybe they're at 40. Well, we can write our options way further out of the money, meaning a lot farther away from where the current market environment is, and then also on a lot less of the portfolio. Maybe that's down in the 50 or 60% range of the fund. And so that allows the ability to still meet your income generation in those high volatility times on an easier basis, but you protect the ability for the equities to appreciate because you've wrote less covered calls against the overall portfolio.
Troy, is it similar on the income side as far as the income products that you have in your suite?
Sure. So on the fixed income side, we're rolling on a weekly basis, and we're not selling calls in those products to bring in the income. We're selling put spreads. So a little bit different of what we're doing from an option strategy. And we roll those weekly because if you notice, all of our fixed income are all, it's in the name, they're all enhanced. So we're trying to give you income over whatever that fixed income portfolio is doing. And we're trying to marry up the volatility of the fixed income portfolio with the volatility of the option portfolio. So the goal is to not bring in additional or more volatility than is already in the portfolio while still giving you enhanced or additional income. And we do that by rolling weekly so we can adjust how far out of the money we are versus where the current spot price is. And so we don't want to get too close to that spot. But when you see volatility like we did over this past month, we had this big sell-off, volatility moves higher. The fixed income products can take advantage of that as they're rolling on a weekly basis, bring in additional income while still selling those put spreads further out of the money and moving away from where spot is. And then when we do get a bounce back like we did on April 9th, and we see that big upward movement, not only do we get a lot of this lost NAV, lost appreciation back into those fixed income products, but in the high income products, you could see just for, as an example of what Garrett was saying there, where we wrote the calls and how far out of the money because heightened volatility in the market, we were able to capture over 90% of the upside in, say, QQQI or SPYI when we had that big up day. So we want to make sure we're there and can appreciate those products as the market moves higher while still hitting those target income ranges, whether it's on the fixed income side or on the equity side.
Excellent. And Garrett, back to you. I mean, during times of volatility in the equity markets, people are more interested in hedge strategies. What do you do as far as your hedge strategies, and How does that work as far as the options market?
Yeah, so I think one structural stance we take is we like to rebalance those hedge strategies on a monthly basis, right? So you're ebbing and flowing with the moves on a much more shorter term. A lot of hedge equity products out there are either based on a quarterly, semi-annual, or annual reset. And so by being able to rebalance the portfolios on a monthly basis, we feel it helps buffer some of those drawdowns and have less losses within the equity part of the portfolio, but still focusing on that income generation. So we actually saw a lot of interest, a lot of conversation over the last 30 days within our hedged equity products of people looking to say, okay, there's an element to my equity risk that maybe I had a little bit more overweight from the advisor standpoint. And so there's a shift into hedged equity to say, okay, could I have a third or half of ultimately the drawdown or risk within a portfolio that my client was used to seeing, but still generating a really tax efficient monthly income, and knowing that that is going to reset on a consistent basis to where the advisor, the end investor, doesn't have to worry about doing that themselves and constantly shifting from product to product, and that it can be reset on a monthly basis to where, the current market conditions are. So definitely a lot of interest we saw, over the last 30 days on ways to mitigate that volatility and equity drawdowns, but also just take advantage of heightened volatility when you're looking at equities, or as Troy talked about, fixed income, alternatives hedged. I mean, that's the idea of what we just try to produce here, is just work with investors to harness volatility as an opportunity for their portfolio and a way to generate tax efficient income with them espousing their risk profiles or their needs across certain, asset classes or areas of their portfolio.
Troy, Garrett was earlier making the case for during times of volatility, there's an opportunity to grab more premium. Have you had conversations with investors who've said, hey, during these times, based on the way your strategy works, would we expect to get some outsized distributions? Would they expect bigger distributions? Could you give them bigger distributions? And is that part of the strategy?
That's definitely been a question that's come up a lot lately. And I think especially since we saw volatility spike, as we were talking about earlier, we saw it go over 50, which we haven't seen since COVID. So think about where we've been over the past couple of years, and we still haven't seen the volatility we've seen since COVID until a couple of weeks ago. So a lot of investors were reaching out saying, hey, are we going to get this massive distribution this month, way bigger than we've seen before? And if you look at it on a percentage basis, yes, some of the high income products were a little higher than they were the month before. But again, as Garrett was saying, the way our model works and the way we look at it is we have this target range of where we are hoping to get the distribution to. And then once we get there, the model's able to write further out of the money and on less of the notional. So when we do have these snapbacks and these move higher in the marketplace, we want to participate with that and have your overall NAV appreciate with the market. So it's really important for us to think about that and not overwrite and sell a lot of calls, say in the high income products, just to bring in more income so we could put out a big flashy number. We're not looking to do that. We're looking to manage the portfolio and make sure not only are you getting that tax efficient monthly income, but you're also appreciating your product, your fund over time.
Yeah, and Garrett, ideally, it would be market starts correcting, you're not giving back as much, but then if you're grabbing that distribution, you're also able to participate more if the market snaps back. Again, you're never timing that, but to a great degree, does that happen from time to time?
It does. Actually, when you look back at the markets, a lot of times you have V-shaped moves, right? Not everything is always a sell-off and then a consistent flat line across, right? It's usually tends to not be a full drawdown and then just sit there. And so I think as you look back at history just in the equity markets, what our models are trying to at least take advantage of is the fact when equities are higher, at least in the equity high income suite, when equities are higher and volatility is coming down, you write on a little bit more of the portfolio, a little bit closer, and it generates that income. It does two things: meets your income need and buffers the portfolio that if the law of probabilities happen and the market corrects, you've done better by protecting a little more of the portfolio and generating income. Same thing, when that happens and that vol event comes and the markets are down, right? You want to generate the income to meet the needs of investors, regardless of what market cycle we are in or event we're in. But then you want to protect that rebound, because that's what helps fulfill the long-term compounding effect of, the net asset value of the fund. And so I think we do look at things very differently than a lot of other managers, and how our models react to looking at the total return and how it fits, the needs of an equity allocation if you're in the equity high income, or how a hedged equity should fit in a hedged equity bucket, or a fixed income fits exactly where your current fixed income is. And so I think that's what we really try to relate to. And as we're big investors in our own products, that's how we view it. They should fit where they're appropriately supposed to in that core underlying position, an asset class is within each respective fund.
On the podcast, we've talked about how all option strategies are not created equal. There are more and more players in this space. I saw that there are more options overlay or covered call strategies that are coming to market. But how might what you're doing differ from covered call strategies that don't really take that dynamic approach? Troy, can you touch on that?
Sure. I mean, there's a number of products out there, as you're saying. The space continues to grow, and I think one of the most important things, which we're trying to do, is educate and have people understand what they're investing in, and looking and dissecting the actual portfolios, and understanding, are you holding equities, or are you just holding option positions? Are you looking at zero DTE, which seems to be in more and more products, zero date to expiry options? Or are you rolling on a monthly basis like us? Or as Garrett was saying, some of those hedge products roll on a quarterly or annual basis. So it's really important for that education piece. And as we look at these products coming out, it's really important to look at who the managers are. Are they in the space? Is this a one-off for them? Have they been in the space before? So for us, as we look at all these different products coming out, for what we're looking to do in a more dynamic nature, looking at our rules-based strategy, looking at how these products and our overlay can change month to month depending on a number of factors with volatility and the rate of change of volatility, and looking at that versus others that might be either more passively managed and are selling on 100% of the notional at the money calls, for example, or others that are just trading these zero DTE options. And if you look at that kind of huge bounce we saw earlier in the month when the market bounced back on April 9th, you could see a lot of those products couldn't keep up with the upside of the index because they're not designed to do that. In a normal day when we're up 50 basis points, 1%, 1.5%, something like that, they could perform, accordingly. But in a big upward move like that, a lot of them couldn't perform. So it's something to educate yourself on, understand what you're investing in, and then pick the appropriate ETF that works for you.
Yeah, great points. And Garrett, I mean, it's all about education, especially when more products come to market. There are different managers. Not all managers manage the same way. Garrett, would you say this period of time that we're going through is good? I know in certain ways you've embraced it, but do you think it's going to flush out this market to a certain degree and kind of separate the men from the boys?
I mean, I do, because I think a lot of investors out there sometimes take a leap of faith with investing in a product that might be new, and you want to see it weathered and kind of battle tested. This is certainly one of those times. So seeing how managers perform, seeing how products perform, right, really does separate the people. That is this the product that did what I expected it to do, and how did they perform? Listen, over the course of this month, you saw a massive sell-off. You saw a day where we had, a 10% rally in equities in one day. You saw it give part of that back up. Then you had a rally of 5 to 6% in a week. So that is a tremendous full market cycle, almost in a very compressed amount of time. And I think there's a great opportunity for people to assess, did this deliver what I was supposed to? Did it give me the income I thought it was going to? Did they capture a level of upside? And so I do think this is a great opportunity for all investors to be able to taking a look at the marketplace and see how that fits exactly within their broader asset allocation and their clients' needs.
I know from a product standpoint, you guys are very well measured in exactly what you're bringing to market and when you're bringing that to market. It's been nice to kind of see a regular cadence, and I know you've got plans for more product and that you can't necessarily talk about now as we go forward. I encourage everybody to stay tuned. Garrett, Troy, I know you guys are excited for what's coming as well.
Yeah, absolutely. We love to be a solutions provider and give investors abilities to espouse their beliefs and their needs. So just excited about, helping continue to grow that and give more offerings.
Great. Well, Garrett, Troy, thank you. I look forward to this every month and look forward to seeing you next month on the Monthly Income Podcast. Guys, have a good time.